Will the war between Russia and Ukraine cause a new market crash? 200,000 troops breach Ukraine through borders at Belarus targeting Kyiv, Kharkiv, Odesa, Luhansk, Donetsk to capture the elected government and overthrow it. Putin alleges him to be a Nazi and the leader to be an extremist, a group of drug addicts. US officials say that 50% of the Russians are in Ukraine, with the civilians on the front line, with President Zelensky sipping a cup of tea with them fighting till the end. President Zelensky proudly sends a video of him at Kyiv after successfully defending the capital against the Russian force. The Ukraine troops' rigid resistance has slowed the Russians down as they keep them from getting into Kyiv, with Putin calling President Zelensky as his #1 target. Meanwhile, Germany and other allies have cut off Russia from the SWIFT global payment system. It's been revealed that a total of 198 civilians have been killed, with 3 children in the conflict and about 1,115 wounded, as said by the Health Minister of Ukraine, Viktor Lyashko. And another report states that around 3,500 Russian soldiers have been killed or injured as the Ukrainian force stops the enemies from breaching into Kyiv, as said by Oleksiy Arestovych, an advisor to President Volodymyr Zelensky. But do all of these situations and recent occurrences have an impact on the market? The simplest answer is yes. But how? Is the question. Hey guys, welcome to our channel. Today we'll be looking at the impact of the most recent invasion in the market. But before we begin, let's take a second to subscribe and hit that notification bell so that you'd never miss an update from us. The market is like the electrocardiogram of the world or a country. The graph going high or low tells us about the state and condition of the country. Well, we could see the impact way before the invasion started, and now the current situation of the market is as follows. Thursday morning, domestic markets plunged by 3% as people sold their stocks on a global scale, and the prices of crude oil are on a high tide with $100 per barrel. Now, as the West called it an unprovoked and unjustified attack, the surge in the oil prices caused the stock market to crash globally. While the increase in oil value went over the $101.2 from $70.4 since December 21st, 2021, and it was by 55% over 9 days. The invasion has stopped the oil supply on a global scale from Russia, leading to a shortage in supply, and it seems like the prices can even breach the $110 mark. Russia is the world's second largest oil producer, and their supply can disrupt the economy furthermore. The sanctions that would be imposed on Russia could block the supply, causing more disruption in the world, contributing to the market crash. The main concern as of now is the growing number of imbalances between demand and supply that could and has created trade deficits in many countries. This is mainly due to the Omicron wave, and it could take time for the global economy to get normalized. On February the 16th, MSCI, broadest index of Asia-Pacific shares, fell as it is uncertain that they expressed concerns over disruptions in sanctions and supplies. Gold, the safest asset, rose by 1% when it was last traded at $1,907. Stock markets in Japan, Hong Kong, South Korea, and Australia plummeted by 3%. Dow Jones fell by 1.35%, while Nasdaq fell by 2.6% on Wednesday. The invasion persists for a long time. The crude oil price will increase even more and stay at an elevated level. This is a major red alert, and so the US Federal Reserve has scheduled a meeting to discuss and come to a conclusion about the increasing interest rates and tightening liquidity. It seems like they might not impose strong sanctions as they are at high risk too. Eurozone economist chief at the research firm Pantheon Macroeconomics said, "Energy prices will keep rising and equities will keep falling." When all of this is happening, there also has been a growth in the market in the S&P 500 and mostly in their energy sector, and they have a very good growth. With a return of 21.8% through Monday, Occidental Petroleum, Halliburton, and Schlumberger are leading the S&P energy sectors. This broke the fall and the overall index went down by 8.8%, but it could have been worse. We can also see that American investors have stashed about $140 billion in commodities, ETFs, mainly focused on companies that deal with energy. For instance, Energy Select SPDR Fund returned 23.4% on Monday with $35 million. But if you're going to sell your investment, you might want to listen to Jeremy Schneider, a personal finance expert at Personal Finance Club, wherein he said, "Don't pull your money out. Don't stop investing. Any reaction you have to the situation is more likely to hurt you than help you. If you're an investor and you're worried about the rising interest rates, inflation, and tight supply chains, most financial advisors are saying that these effects are short-term and it will become normal in the long term. Now global stock sell-off, yen might be looking at a good spot, and while the investors started piling gold, it leads to a rise in the currency value of the dollar. A supply shock to commodities and the need for a higher geopolitical risk premium may mean inflation remains elevated for longer, with a risk of hiking cycle may need to be steeper, said Tapas Strickland, Director of Economics at National Australia Bank. The Russian ruble lost its currency value by roughly 6% over the last 2 days, and it seems like the value will decrease as with the invasion. These sanctions will hurt the Russian economy, and with this, we can also see other currencies losing their value, with the dollar by 0.05% and the euro by 0.2%. The biggest takeaway is that the market can face a huge setback on natural gas and oil, with other countries imposing sanctions on Russia would affect foreign trade. Now, we cannot exactly pinpoint the loss, but it will be gauged by the dependency of the country to Russian markets. For example, Austria might be modestly affected, while Germany might feel the worst of it. The Western sanctions that have been imposed on Russia will further damage relations between the country. The damage taken by Ukraine was estimated at around 6 billion euros, which was about 6% of Europe's GDP and 16% of Ukraine's GDP, which is likely to be repeated. While on the other hand, Russia, with its stagnated economy, would also feel the heat as well. The first would be the sanctions are much like an investor repellent, economic growth, and modernization. This will make companies not invest in Russian companies, and even if someone is making a trade, they will be met with penalties. Russia will be cut off on a global level, which will also mean if they still do business with other countries and earn money, and then keep their incomes in the country, it would make Russia a black hole of value. As we can see, some countries are hesitant about cutting ties with Russia, but they will be affected. Now, the sanctions didn't do much in the past, as despite the relatively low European trade exposure, they on average did have good ties with the Baltic states, Finland, Cyprus, Greece, Britain, Spain, Portugal also have a good relationship with Russia after the annexation of Crimea, which means that the sanctions may not be an efficient way to punish the aggressor. Anyway, as I said, Russia could be a black hole of value, as these sanctions can easily backfire with the need. For instance, if Germany needs oil and they secretly buy from Russia, the value is only circulated in Russia, which will further increase with secret trade. The value will only circulate in Russia, and then this foreign value will bloat ruble, Russia's currency. An isolated nation will then be more self-sufficient, making them stronger as they produce more for themselves, and their economy will bloom with the people coming together. Strict sanctions might look dangerous, but with time, it can potentially make Russia stronger. So that will be it, guys. Thank you so much for watching, and we'll see you next time on the channel.